Friends, good afternoon and welcome to our today's session on business valuation. We have some basic understanding about valuation. In the previous session, some of the sessions we had discussed that what is it. So today what I'll be doing, I'll be showing you a valuation report. We'll be understanding that thing, and some basic concepts we'll be also discussing. And also, prior to that, when you talk about valuation, that two things are involved. One is you have to crunch some numbers, and these numbers will be taken from the financial statements mostly, right? So, and when you look at the financial statement of any business, there are some stories behind these numbers. For example, let us say you are saying this is the turnover. So we need to know what is the story behind this turnover, how that turnover has been computed, how that figure has been arrived. Is it done? Or something, let us say you are saying this is the value of the property, plant and equipment. We also need to know how that value has been arrived. Okay, so both are important. Numbers are important, and the stories behind these numbers that are also important. And before starting evaluation, we need to understand the business first of all. Is it done? And when you say we have to understand the business, many documents we may refer to, but the most important things which will be relevant to evaluation is the entities or the businesses financial statement, right? And when you talk about the financial statement, you already know what are the components of this financial statement, what I'm talking about. Can you quickly tell me that these are the financial statements I'm talking about, which will be helping me to do a business, to evaluation of a business? Can you tell me? In fact, I'm asking what are this financial statement and what is the meaning of these financial statements?
Yes, so we have 4 financial statements.
Okay.
The first one is the balance sheet, which tells us the position of a company at a certain point of time.
Very good, very good.
We have the profit and loss account, also known as the income statement, which tells us the performance of the company for a period of mostly 1 year.
Fantastic.
And we have the cash flow statement, which tells us about the inflows and outflows of cash in 3 different categories of activities.
Yes.
And then we have changes in equity.
Okay, statement of changes of equity. So these are the 4 statements you are talking about. But if you look at this statement, these are basically the numbers. Is it not? It contains lot of numbers. But if you see, in fact, behind every number there is a story. For example, let me show you some of the financial statement. So if I show you, this is, you see, I'm showing you right now annual report of a company right now. If you look at their financial statement, you see, just have a look at, I can show you in Excel also. Can you see it? Balance sheet?
Yes.
Are you able to see it? Okay. So
yes.
Balance sheet, if you look, these numbers are there. Let us say this is the current previous year figure, these are current year figures. Okay. This is for previous reporting period, this is for current reporting period. And you see, this is the list of note numbers, note number 2, note number 3, like this. And if you look at these notes, to turn this page, if you see these notes, you can find these are the notes. For example, if I want to understand for here, let's say revenue. Are you getting revenue? What is the note number? Can you read it? Are you able to see the revenue note number?
No, sir, we are not able to read the numbers.
Okay, so it is page, is it not? So I'll do one thing. I'll be showing you an Excel file right now. Just give me 1 minute and let me show you some financial statement. Okay. Just give me a second.
Sir, you're on mute.
Friends, I'm going to share the financial statement of a company. Just check. I think you're able to see it right now. No, you are not seeing the Excel file. Yeah, are you able to see it?
Yes, sir.
Okay, you see. So you see, this is the balance sheet you are seeing. This is the statement of profit and loss you are seeing. Okay, now you see, if you look at here, you can refer to any company's annual report. You can feel, let us say, you are looking at the statement of profit and loss. You are seeing revenue is this much. Okay, but to understand this thing, what you need to know, you need to refer to this particular note. That note will be explaining you that how this revenue has been arrived at, how the revenue has been recognized. Is it not? Similarly, if you want to understand what is the other income, then you have to refer to this note number 20. Similarly, various items of the balance sheet, if you want to understand, you need to refer the various notes. And these notes will be containing the stories. Okay, how that numbers has been arrived at, you can understand it by referring to these notes. Okay, you can try, you can pick off any company's financial statement that will be helping you to understand how these numbers has been arrived at. Okay, friends, that I think you'll be able to do it. Now, what is the purpose of discussing that thing is that when you do the valuation, it's not that you can develop a model where numbers will be fed and automatically some value will be computed. I'll be showing you practically how that is to be done. Maybe with the help of some Excel file, we'll be able to compute that thing. But before that, we have to understand that we need to read all the stories which are there behind these numbers. Okay, now let us quickly recapitulate what we have learned in our previous session. Then we'll move ahead. So previous session, we are discussing that valuation is a combination of science and art. We can say, you can call it as a craft. So over a period of time, you can improve. So if you practice regularly the process of valuation over a period of time, you'll be able to improve yourself. So this is the basic things we have discussed, and some regulatory aspects also we have discussed. And we are also knowing that some universal methods will be following so that we'll be able to become the global valuers. So we'll be following the methods or the approaches which are suggested by international valuation standards, and methods and approaches which are suggested by Institute of Chartered Accountants Valuation Institute of Chartered Accountants Valuation Standards. Okay, and these are the some sources where from you can get this material. I have told you, you can go to IVAC, that is International Valuation Standard Council. You can visit there. You can visit to Institute of Chartered Accountants Registered Valuers Organization, ICAI RPO website. You can visit to Indian Institute of Corporate Affairs website. You can get some reading material. One important thing which you had discussed in the previous session is that cost, price, and value, they are three different things. Is it not? Okay. Cost, what we have understood, that cost is the reality, you can say, actually something has been incurred. So it is to be computed by applying certain methods. In cost accounting, might have studied certain methods which will be which will be helping you to arrive at the cost. Is it not? Yes or no?
Yes, sir.
And what is price? You have understood. Price is a matter of policy. The seller may decide at what price he is going to sell a particular good or provide certain services. Most of the times, what you find that price is something which is market driven, or market decides the price. But when coming to value, value is a matter of perception. It varies from person to person. It varies from time to time. It is dynamic and it is subjective. And we'll be focusing on computing those values. Okay. And we have also tried to distinguish between value and price. the value is not precisely measurable. Most of the time we calculate value in range. We say this is the value maybe between, let us say, 500 to 600, something like this. But price can be measured precisely. Value is not a static figure. It keeps on changing. But price is a static figure so far as a particular transaction is concerned. And value measures the economic value. Price takes into consideration many non-economic factors also. So that is the difference which you have discussed earlier. And we have also concluded earlier that when you talk about valuation, it's a combination of story and number. A good valuation has more stories than numbers. We need to read the stories behind the numbers, then we will be able to conclude that how far to or to what extent these numbers are relevant for our valuation exercise. Okay. And today, when we started our discussion, we concluded or we are discussing that these are the financial statements which are relevant. And most of the cases, we collect numbers from these financial statements. We can collect numbers from external sources also. Maybe from market, we will collect some numbers. But most of the numbers we'll be getting from these financial statements like balance sheet, statement of profit and loss, cash flow statement, statement of changes in equity, and also these explanatory notes. All these things are important for us. Okay, friends?
Yes, sir.
Okay. Now, with that background, let us first understand the process of valuation. First, let me try to give you some kind of definition of valuation. If you read it here, either some of you can read it. Can you read it?
Yes, sir. I will read. A valuation refers to the act or process of determining an estimate of value of an asset or liability by applying IVS.
Okay. So this particular definition has been taken from International Valuation Standard. Okay. Where it says it's an act or process of determining an estimate of value of an asset and liability. Okay. Here we have to understand one thing, that when we are talking about the valuation, it is not necessary that valuation means valuation of assets only. So liabilities can also be valued. Okay. So we'll be learning the valuation process, assets as well as the liabilities. Okay. So both the things are important. The process, and what is the process, what is the act, I'll be telling you. And this is the definition given by International Valuation Standard. If you Indian context, if you see, this is what I'm showing you. This is, you see, this is the chapter 17 of Companies Act 2013. Okay, and here one section is there, chapter 240, section 247. Okay, just read this. If you just go through this 240 section 247, subsection 1, you see where a valuation is required to be made in respect of property, stocks, shares, debentures, securities, goodwill, or any other asset, or net worth of the company, or its liabilities. Here also, you see, we are talking about valuation of liabilities. Is it not? Okay.
Yes, sir.
Okay. So, if you refer to International Valuation Standard, valuation is also referring to valuation of assets as well as liabilities. In India also, if you see the legal framework, there also you can see provisions are there for valuation of assets and liabilities. Now, that is the basic understanding. You need not remember these definitions, only try to understand what is the purpose of these terms. So we will, or you can say, there is a need to familiarize ourselves with these terms, because when we'll be preparing valuation report, these terms will be useful. We'll be using all these terms. Now, let us see what is the meaning of the term value. The value refers to the judgment of the valuer of the estimated amount consistent with one of the bases of value. One of the bases of value set out In IVS 104, name of that IVS is basis of value. That means one thing is important, that when you talk about the value, it depends upon the judgment of the value. And he has to arrive at that value, which is consistent with some of the basis of value. So there is a need to understand what is the basis of value. What happens in the valuation report, valuer decides what are the valuation basis. Okay, right now we do not know what are the basis. I'll be explaining what are the basis. But when you are talking about any value, you have to appreciate one thing, that the value should be consistent with some basis of value. That means there will be various bases. One of the base valuer might have adopted. On that basis, he must have value. Okay. Right? Definition may appear to be little technical, but purpose is that you need to keep in your mind there is something called as the basis of value. We need to understand what is this base, what is the valuation base. Without understanding the valuation base, I may not be able to start the valuation. Okay, friends. Should I move ahead?
Yes, sir.
Okay. Now, one more definition is there for value. This previous definition I was talking about, this was given in the International Valuation Standard. Now you see this definition of value is given in the Indian Valuation Standard or ICA Valuation Standard. If you see, value is an estimate of the value of the business or business ownership. Business ownership interest arrived at by applying the valuation procedures appropriate for a valuation engagement and using professional judgment as to the value or range of values based on those procedures. So if I summarize this particular definition, here it is saying that when we are talking about a value, we have to estimate, or the valuer has to estimate. And the valuation may be relating to the business or business ownership interest. But how you will be able to arrive at the value? After applying the valuation procedures, which is appropriate. So in the appropriate situation, you have to decide what is the valuation procedure which has to be adopted. Okay. So in different valuation engagement, you might have to decide different valuation procedures. Which valuation procedure is appropriate? That depends upon your professional judgment. So you need to know what are the valuation procedures. Okay, then you will be able to apply your professional judgment, which valuation procedure is relevant. On that basis, you'll be able to, or you should estimate the value. Okay, so the definition of value, which is given by International Valuation Standard, and the definition of value, which is given by ICA Valuation Standards, they're different things. Okay. Now, having understood the value, there are various types of values. Okay, like something is called as the fair value, something called as the going concern value, something called as the participant specific value. So like this. Okay, would you like to know what are these values?
Yes.
It will be little theoretical, but still let us cover that thing. Then I will be showing you some practical things. Now, first of all, we need to understand what is fair. So we have to refer to ICA Valuation Standard. Here it is saying, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant at the valuation date. So what is important here? When we are talking about the fair value, you have to see what is that price which is to be received to sell an asset or which is to be paid to transfer a liability. But we have to also ensure that the transaction should be an orderly transaction. If the transaction is not an orderly transaction, we cannot take that price as a fair value. Can you think of some transaction which is an orderly transaction? Suppose, let us say you are selling a piece of land to your relative for 20 lakh. Okay, can I take 20 lakh as a fair value? Can you say that transaction is an orderly transaction? Answer me.
No, sir, I don't think so.
What is the reason why you feel this is not an orderly transaction? Let us say you are a valuer. Okay, you are giving the evidence that this is the price, 20 lakh has been received. Okay, but you came to know that the purchaser is the relative of the seller. Can you take that transaction as an orderly transaction?
We cannot, because it's not
You
in the
cannot.
normal course of the business.
Okay, you feel this is not in ordinary course of business. Okay, and as you see, it depends upon the facts and circumstances of the case. So valuer should be able to apply his judgment that whether it is an orderly transaction or not. Let us say someone is forcing the seller to sell that particular goods. Can you call it an orderly transaction?
No.
No. Okay. So most of the cases you can find that by applying common sense also you'll be able to decide whether the transaction is an orderly transaction or not. If it is not if you feel it is not an orderly transaction, you may reject that price as a value. Okay, you can reject that is not a fair. Okay, by explaining the reasons. Anyway, I'm going to show you the definition of what is orderly transaction, but without knowing that also, by applying your professional judgment, you'll be able to decide whether that is an orderly transaction or not. Okay, what is that orderly transaction? Let us quickly see that thing also. So, orderly transaction means you have to see the transaction is usual and customary for the transactions. All the marketing activities are customary for the transactions, and it is not a forced transaction. So if you find it's a normal, usual transaction and not a forced transaction, you can call that transaction as an orderly transaction. Okay, so that is important to arrive at the fair value. Then one more type of value is important, which is called as the going concern value. This refers to the value of the business enterprise that is expected to continue to operate in future. So as you know, when a balance sheet of the business is prepared or a financial statements are prepared, there are some fundamental assumptions to that. Okay, one of that assumption is that going concern assumption. That means business will be continued as a going concern. There is no intention to close that business. Okay, so keeping that thing in mind or expecting that the business will be continued in future, if you arrive at the value, that is called as the going concern value. Okay. Okay.
Yes, sir. Okay.
Now, similarly, there is something called as the participant specific value. That means this is the value which is specific to the participant. One of the participant, that means either buyer and maybe seller, may be having some specific advantage. And that maybe if that particular asset or particular goods might be having some specific advantages or disadvantages, either to the buyer or to seller. Therefore, value will be different for them. You can call that as participant specific value. Okay, so like this, there will be various other types of value which will be learning in due course. Okay, we know something called as the going concern value, fair value, participant specific value. There might be liquidation value. Like this, so many other values will be there. Will be learning in due course. But why right now we are learning all this theoretical thing is that now I am going to show you a valuation, and in this report, these terms will be there. Okay, so that will help you. Now you'll be able to. Earlier also we had seen one valuation report, but today I think we'll be able to understand it in a better way. Okay, are you ready? Should I show you that thing? Then I will be also showing you how calculations are made. Okay. And in between, if you have any query, feel free to raise your queries. Feel free to ask. I'm going to share the valuation report with you right now. Just give me a moment. Okay. Are you able to see it now? Please respond.
Yes, sir, we are able to see the valuation of equity shares report.
Okay. Valuation of equity shares is of a particular company. Now, what is important here? You see, one thing is final opinion will be there. Background of the company when one need to understand. That means you need to understand what is the business of the company, what is the background of the management, and you need to analyze the market so that your understanding will be better. Maybe capital market analysis, company analysis you have to do, right? And one point is there, what is the scope and purpose of report? You see one paragraph is here, scope and purpose of report. Sources of information, standard value. Okay, you see one term is used, fair value. Are you seeing it? After seeing that thing, I'll be showing you again the requirement of international valuation standard, where it has been specified what should be contained in a valuation report. But now see it minutely. After that, you tell me whether this report is in order or not. Okay. Scope is there. Yes or no? You can unmute. You can unmute and report. Are you finding scope of this report?
Yes, sir, there is
Sources of information. You see standard of value, valuation base, valuation methodology, approach. Which approach is followed here?
the income approach.
Income approach. And which method is followed?
Discounted cash flow method.
Discounted cash flow method. Good. Discounted cash flow method is followed. Okay. Then you see, it also shows what are the steps in the valuation process. Okay. Then some impact of COVID-19 on this valuation. Assumptions are there. Statement of limiting conditions, working, and other things are there. Now you see how the report normally looks like. This is the opinion of the valuer. Okay, valuer has arrived. He has arrived a value that for equity shares value is 497 rupees. Okay, so this is opinion. Okay, this is the executive summary of the report. We'll again come back to that. But these are certain factors. And subsequently, we'll be learning how these factors are relevant. These factors, we need to compute all these factors, then only we'll be able to compute the valuation. What is this factor? Can anyone explain what is RF? Any guess?
RF is the risk-free rate of return.
Very good. This is the risk-free rate of return. We'll be learning how to compute that thing. Then here it is sector unlevered beta. We'll be also knowing how to collect this data. Then companies levered bottom-up beta. This is one more factor. When we are coming to this income approach, this computation we should know. Okay. Then high-low risk. Then market rate of return is also relevant. Then K capital D represents pre-tax cost of debt. K small d represent post-tax cost of debt. KE represents cost of equity. WACC stands for, this will be able to say, WACC. What is that?
Weighted average
Weighted average cost of capital has been computed here. Perpetuity growth is also computed 3.5%. Okay, so these factors have been computed. These are in fact the key factors. If these factors will be changing, this value will be different. And if you see here, the book value of the equity of the company is how much? 2,086 rupees, but whereas the fair value is 497 rupees. So we need to understand what is that. One value is book value, other value is a fair value. Okay, their values, are you seeing they're substantially different or not? 2,086 rupees and 497. Is that different? Is it not? Okay. Now, of course, this background of the company, we can see this is a construction company. That part you can do it. Now you see, one can understand that thing, management's background, depending of the company, one can analyze. Then company is working a particular industry. You need to see what is the behavior of the industry in the stock market. That also one can analyze over a period of time. Okay, what kind of return they are giving. Industry analysis one can do over a period of time, whether construction industry is growing or showing a downward trend. One should know. Accordingly, one will be able to compute future projection. Okay, so if you want to compute future cash flow, you need to know what is the growth. Yes or no? And to understand the growth, you might have to refer to history. You have to see historically how this particular industry is growing. On that basis, you'll be able to compute. Okay, then you see company analysis. One has to see that what is the capital structure of the company. Okay, here you see the sources of fund. One can see the capital structure here. An application of the fund where investment have been made, let's say property and plant and equipment, other non-current asset. One can analyze this thing. One can compare the current asset and current liabilities. Okay. These things are required to understand the business. Are you getting me?
Yes, sir.
Yes.
And on the basis of balance sheet, you see book value is computed. Book value of the shares are coming to 2,086 rupees. It's a very simple method, book value method, that arrive at the balance sheet value of assets, balance sheet value of liabilities. Okay, some adjustments like deferred tax assets, liabilities should be made. In this situation, that was not there. Therefore, those adjustments are not there. So when I'll be teaching you the method, at that time you'll be understanding. So by applying this simple process, this book value has been arrived at, but book value is not the fair value. And you see, scope of this report, it says, what is the basis of valuation? It says, method of valuation, discounted cash flow method, it says. What are the sources of information? The valuer has disclosed this thing. Shareholding pattern, we need to check that whether this proposed issue, if some shares are needs to be issued, whether it is affecting going to affect the controlling interest. So for that thing, some adjustment has to be made. So we need to understand what the shareholding pattern, who is holding how much of shares, that can be seen. And here you see one important thing is that what is the premise of value? The premise of value, that concept we have to see. Here we have taken going concern value. That means business will be continued. In that premises, this valuation is correct. And the standard of value is adopted is fair value. Fair value has been arrived at. And what is valuation base? You see, these are the valuation bases. Certain valuation bases are there. Let us say fair value, participant specific value, liquidation value. But here in this valuation, fair value has been selected. Okay, the valuer has selected fair value as an appropriate valuation base. So valuation base is fair value. And valuation methodology, just you have a look at this methodology. Then in detail, we will be learning. First, you need to calculate future operating cash flow. You need to compute perpetuity growth. You need to compute market rate of return. You need to compute what is the systematic risk curve beta. You need to compute risk-free rate of return. On that basis, you'll be able to compute cost of debt and cost of equity. Then you calculate what is weighted average cost of capital. Then arrive at the present value of free cash flows. Arrive at the terminal value. Then arrive at the total free cash flow to equities. If there is some premium is involved, add it. If some discount is involved, reduce it. Then you will arrive at the enterprise value. From that enterprise value, you'll be able to compute what is the value of shares. Okay, this process, when we'll be doing it, it will be more clear to you. But here in this valuation report, income approach has been followed. And this is the process what you have to do. Cash flows are most important here. And cash flow is, this is the process which you have to follow to arrive at the fair value by following discounted cash flow method. Okay. If I change the method, value may also change. Here also, why cash income approach is followed? Here there is a discussion that what is market approach, what is cost approach, what is income approach. And here there is justification. You see, the potential earning power of a company is generally paramount factor for valuation of shares. But there might be occasions, especially in valuation for compensations, where other considerations become relatively more important. In absence of any other specific motive, investor is principally interested in the company's ability to continue earning profit. Keeping that in mind, income approach has been followed. So Valuer has selected income approach, and this discounted cash flow method is a method under income approach, and that method has been adopted. Okay, cut-off date of valuation is 15th December. This is the new report you can see, and steps involved in the valuation report is also discussed here. Projected cash flows are computed, future cash flows. Risk-free returns, you see, it is computed. Unlevered beta is computed. Then company specific levered beta is also computed here. Okay, then market rate of return is computed. Cost of equity is computed. Cost of debt is computed. Weighted average cost of capital is computed. Perpetuity is taken. Higher risk is taken from a database. Okay. On that basis, certain adjustments are made. Then value per share is arrived at. On this basis, value per share, you can see 497. Okay.
Yes, sir.
Okay. Now, calculation part, I will be showing you how these calculations are made. Other disclosure, statement of limiting conditions, assumptions are there. All these things are there. So that will be same. Now, this was one report where you have seen the income method is. Okay. Now, one more method. Let me show you that thing. Just give me a moment. One more valuation report I'm showing. Now, are you able to see it now?
No, sir.
No. Just a minute. Yeah. Here you see one more report I'm showing. I think you're able to see it now.
Yes, sir.
Yes.
We are able to see it.
Okay. Now you see, this is another company's report. Just some important things I'll be showing you. This is also a valuation report. You see, value of equity shares is coming 394 rupees. But here you see what is the method followed. Can you read it? Replacement cost method. Okay. So different method, if you will follow, you'll be getting different valuation. But how replacement cost method you see. Here you see what is the approach of valuation. In the previous report, it was income approach. But what is the approach here? Can you read it? Valuation approach. Are you able to reply me? Will you be?
Yes,
sir.
yes, sir.
Yes.
Valuation approach, cost approach.
Cost approach. And what is the method?
Replacement cost
method.
Replacement cost. Earlier, it was income approach and discounted cash flow. Is it done? Okay.
Yes.
Okay. So this is a different method has been followed. That means valuer in different point of time might have to decide that which method is appropriate. And if he's selecting a particular method, he has to give reasons that why that method is selected. Okay, here also in this report also, if you see, all other points are there in different way it has been calculated. Here you see, valuer has also given justification. In absence of comparable market price and projection of future income, it was not possible to apply market approach or income. So friends, try to understand there are three approaches of valuation. What are they? One is your income approach, which you have already seen. This you are seeing as the cost approach, and one other approach is the market approach. So here valuer is saying market approach and income approach is not possible. So therefore, he is following this cost approach. Understood?
Yes, sir.
Okay. Understood? Right. Fine. Now, I'll be coming to one more valuation report. So, three approaches I told you. What are these approaches? One is market approach. Second one is income approach. Third one is cost approach. Now, income approach I showed you, and this thing, cost approach also I showed you. Cost approach is very simple, almost like on the basis of book value of the assets and liabilities or replacement cost of the assets and liabilities, you can arrive at the value. Okay, cost of the assets minus cost of the liabilities is the value of the business. Okay, you divided by number of equities, you can get the value of equity share. Per value, per equity share, you can get the value. It is that simple. Okay, but which cost has to be, we are going to take? Okay, so whether historical cost or replacement cost, that is a question. In appropriate time, we'll be learning that when we'll be coming to various methods. Right. Now, one more valuation report I am going to show you. This is about market, right? Market valuation method. Just a minute. Just let me show you the relevant pages only. Yeah, are you seeing it? Determine market approach valuation. This is another valuation report you see, where market approach valuation has been followed. Here, what has happened? It is very simple to understand this valuation. You see, this is also a company, you can say property developer. So from the market, various other property developers, financial figures are taken. Suppose these are the listed company, their last share price, their changes, 52 weeks high value, 52 weeks low value. You know, these things are available in the websites of the stock exchange where they are listed, and their market capitalization. Okay. Now you see, let's say Godrej Properties, Suntech Realty, let's say India Bull Real Estate, like this. These are the companies you have taken where the last quarterly sales were this much. Okay. If I convert this into annual sale, then I have to multiply it with 4. So these are multiplied by 4. So these are annual sales. Right? Now, very simple process. If this is the annual sales, this is the market capitalization. And the company I am valuing, what is its annual sales? So on that basis, I'll be able to find out what should be its market capitalization or what should be its value. Is it not? So market capitalization figures are there, the turnovers are there. Out of that, one market multiplier factor is calculated. Here, this company is 3.23, 2.87, 1.86, 2.43, 1.58. On an average, it is 2.39. Okay. Once you know that thing, multiplier is 2.39 and your turnover is this much, you can find out what is the derived value. And since this company is not marketable, this is not a listed company, so you can give a discount for lack of marketability. That's a DLOM. Okay, DLOM 20% is allowed. Suppose now your value is 8,679. Sorry, value is 6,940. Understood? This is one more approach. And also, valuer can use multiple approaches. Here in this report, if you see what the valuer has done, you see, valuer has said under income approach, business value is this much. Under market approach, business value is this much. Valuer has given different weight. 200% weight is given to income approach, 100% weight is given to market approach. On this basis, weighted average value has been calculated. And the finally, value has arrived at 6,135. Okay, and 40 lakh shares are outstanding, so per share value is 149. These figures are also in lakhs. Understood?
Yes, sir.
Got some idea about these three approaches?
Yes, sir, we have got some idea.
Okay, now friends, I am again taking you to my PPTs. So we were in fact discussing various types of values are there. Valuation approaches are there. Now, few more things I would like to share with you. Now you see, this is again a particular paragraph taken from International Valuation Standard. This standard says that this should be the content of a valuation. When you do the valuation, in your report, at least these things should be there. What are these things? Scope of the work should be there. What is the intended or purpose? It should be there. Approach, mention, some methods, key inputs, assumptions, conclusions, and data. These reports that I had showed you, I think 2 reports I showed you fully, another report I showed you partial. Whether these things were there or something was missing. What do you say? Everything was there? Can you reply?
Yes, I think everything was there.
Okay, we'll again cross-check some other time, but all these things were there. To the best of my knowledge and belief, these things were there. So you can see those valuation reports are prepared in accordance with the International Valuation Standard, because the content which will be there, these are there. Now, what is this valuation base? I'll be telling you later on. Practically, we'll be seeing it, what is the valuation base later on. Now, let us first see some of the steps which are involved in the valuation process. First, we need to decide what is the valuation base, what is the valuation premise. Then next step is that we need to analyze the asset to be valued and collect necessary information from various sources. Will be collecting information. Once you've decided is the valuation base and is the valuation premise, then collect information. Then identify if some adjustments has to be made. Sometimes what happen, just like that you have seen under market approach, there is an adjustment, discount for lack of market liquidity. Because the company which you are taken, they are listed companies, they are freely marketable, their equities. And these companies' equities are not freely marketable. So one need to adjust that values. Therefore, 20% discount was given. Okay. Sometimes maybe someone is acquiring shares to have a controlling interest. So he has to pay some control premium. Like this, some adjustment needs to be. Okay. Now you need to consider what is the valuation approaches, what are the methods. Then arrive at the value or range of value. Then if there is some other event, you may get the valuation adjusted. Then finally issue the valuation. This is the process. Now have a look at this chart. It will give you some idea about the approaches and methods. Methods, each of these methods will be learning. Practically, we need to learn. Theoretically, understand it will be a little difficult to understand this thing. But today, whatever we have seen, I think you've got a fair idea about what is market approach, what is income approach, what is cost approach. Okay.
Yes, sir.
Okay. Now, what is important here? First of all, let us talk about the market approach. To do a valuation following a market approach, what is important is that you have to have some comparable figures, some comparable data needs to be available. Okay. Then on that basis, you can decide some let us say multiplying factor, you can arrive at the value. Okay. Maybe on the basis of turnover, maybe on the basis of profit, maybe a profit, maybe on the basis of, let us say, profit after tax, or maybe on the basis of PBIT. So you can arrive at what is the market value and what is the multiplying factor. By using this thing, you'll be able to compute the value of the equities and the value of the business. Okay, but market data needs to be available for that. So by comparing that data, you decide what is the value, or you arrive at the value if you are following market approach. Okay. Now, if you are coming to income approach, here, even if there is no comparable, doesn't matter. What you need is the future projection of your income or projection of your cash flow. And here, what exactly we do, we capitalize or we arrive at the present value of those cash flows. We arrive at the net present value of that cash flows. And if you assume that business will continue for perpetuity, then we arrive at the terminal values. Okay. And the present value of those cash flow is the value of the business. And once we know the value of the business, we can arrive at the value of equities. Okay. Understood? Both the approaches you have understood. What is market and what is income approach? Okay. Market approach, you need to compare. Under income approach, you need to arrive at the projections, future cash. And under cost approach, you have to understand that cost approach is based on a simple philosophy that value, that means practically no one would like to pay more than the cost of something. In certain situations, if people feel what is the value? Value is the cost. If I want to replace that asset, what is the cost? Or historically, how much cost I have incurred? In certain situations, that may be the value. Okay, suppose someone is interested only with the assets of the company, he doesn't want to continue with the business, he wants to dispose of the asset. So for him, realizable value may be the realizable value of all these assets, the value. So he may follow a cost approach. And under these approaches, there are various methods. In the chart, I was showing you various methods are there, which we will be learning in due course. Okay. Now, once again, I'm showing you this chart. So just have a look at certain methods. Let us say you are following market approach. You may follow a market price method, comparable companies multiple method, comparable transaction multiple method. If you are following income approach, you may follow the discounted cash flow method, earning capitalization method, dividend discount method. And for intangible assets, you may follow the relief from royalty method, multi-period excess earning method, with or without method. And for options, you may follow the option pricing models. And if you are following the cost approach, you may follow the replacement cost method or reproduction cost method. Okay. Don't worry, we are going to learn all of them one by one. But at this stage, have some idea that there are 3 approaches, and under each approach, there are multiple methods which may be adopted by the way. Okay, friends?
Yes, sir.
Okay. Now, few other things. Let me tell you. Here, one para you need to learn from our International Valuation Standard. That if you refer IVS, International Valuation Standard, it says the valuers are not required to use more than one method for valuation of an asset, particularly when the valuer has high degree of confidence in the accuracy and reliability of a single method. So if you refer IVS focuses or IVS insists that you should try to follow a single approach for one particular valuation, one approach. Okay, multiple approaches to the extent possible may be avoided, but you may consider use of multiple approaches. At only one valuation report, you have seen multiple approaches are followed. Market approach and income approach. Income approach was given the weightage of 200, market approach was given the weightage of 100. You may do that. You may consider use of the multiple approaches and methods where you find that there is insufficient factual or observable inputs. That means if sufficient input data is not there to follow a particular method, then you may follow multiple approaches. This is according to International Valuation Standard. Okay, but if you refer to Indian Valuation Standard, I'll show you some other time. I will show you. There also, it has been explained that multiple valuation methods one can follow, multiple valuation approaches one may follow. Okay. Now, friends, having understood this broadly, that when we'll be learning valuation, we'll be learning all the 3 approaches and various methods will be there. And we need to collect some information from those, collect some data from market, collect some information from the financial statement, and we need to compute these key factors, right? Finally, we have to develop some kind of model so that effectively we'll be able to value an equity. Right, having understood that, now this is time to practically see a model, how valuation happens. Okay, so today, my intention was to give you an overview that actually what are the things involved in a valuation process, practically how to see it. So that will be complete if you look at this model. One model I'm going to show you. Okay, are you ready?
Yes, sir. Ready.
Okay, so just give me one moment. Let me, sorry. Let me find out one model for you. Just give me a moment. I'm trying to open the file for you.
Yes, sir.
Are you seeing some Excel file or are you seeing only a folder? I'll be showing you Excel file, right?
I'm not able to see anything actually. You're
Okay,
sharing.
now
Now
you'll be able to see. Yeah, now you'll be able to see. Okay, you see. This is in fact a model with the help of which valuation is done, but you have to develop this model. You see, here different sheets are there in this Excel file. First of all, you see this is the company's master data which has been collected to understand the company. It has been collected from the Ministry of Corporate Affairs website. You'll be able to know it so that you can understand what is the authorized capital of the company, what is the paid off capital of the company, when the company is incorporated, is there any asset which are under charge. You can understand all these things very effectively. This is collected. Then risk rate of interest. You see, this is one more sheet is there where from Reserve Bank of India, some treasury bill or some central government securities are taken to compute risk rate of interest because that is important. Okay, are you seeing it? Then you see market rate of return is computed by referring to Bombay Stock Exchange website. But from, you see, from April 2003 to till date means, yeah, December 2003. What is the closing price of Sensex? What is the movement? What is the return they are offering? On that basis, it has been computed. What is the average annual return? Annual return in this case comes to 0.18, means 18.54%. Okay, this is the market return. It has been computed. Okay, understood? Sector-wise beta data is available from some external sources. From there, this beta data is collected. Company shareholding, you see, who are the shareholders? That has been incorporated here. Weighted average cost of capital, cost of debt, cost of equity is calculated. Weighted average cost of capital is taken 0.14, means 14.18%. Cost of equity is calculated here by, this is the model CAPM, capital asset pricing model has been applied. Risk rate of return plus beta into RM minus RF. On that basis, cost of equity comes to 0.14, means 14.30%. Okay. Growth rate has been computed by taking historical data. Growth rate has been taken here. Perpetuity also by taking historical data. In best case, worst case, average case, what is the perpetuity? That calculation has been done. Okay. What is company's operating cash flow? That has been calculated. What is company's total cash flow in different future years? Okay, in future years, in different years, these are the cash flow. Company is expecting this much of growth in its cash flow. Right. Then valuation is done. But before coming to valuation, what is the industry work you have computed? You have also compared with the industry work. What is the weighted average cost of capital of the industry? What is company's source and application? What is its capital structure, application of fund? What is its current ratio? All these things you are seen in the reports, but they are calculated here in this Excel sheet. And finally, this is incorporated in that report. But this is the calculation sheet. Okay. Yes, you have all seen all these things in this report, in that report. Okay. After all these things, valuation has been done. If you see, in this company, valuation has been done. This is the cash flow. What is the value of business? Okay, what is the debt obligation? That is reduced. Debt obligation, that cash and cash equivalent added. Premium, there is no control premium, adjusted value. Finally, you see value of shares has been arrived. Here per share value is rounded up 1881. If you adopt different methods, value will be different. Okay, if you follow a pessimistic approach, value might be something. If you follow an optimistic approach, value might be something else. So real value will be somewhere in that range. Pessimistic approach, optimistic approach, in between somewhere in that range. Okay, and again, let us say income approach, one value may come. cost approach, one more value may come. And market approach, some more value may come. Under income approach also, if you are following one method, one value you'll be getting. If you're following a different method, you'll be getting a different value. Okay, so this exercise involves a lot of judgment impact. So now I think you got some idea that how we'll move to a valuation of a company.
Yes.
Okay, so are you confident that you'll be able to do the valuation? And this model you have to develop. Don't think that I'll be giving you some ready-made models. In that case, you will not be learning anything. You have to develop your own model. That this is how I'll be collecting data. This is how I'll be computing various factors. And finally, you'll be developing your model and value can be arrived. Okay, friends.
Yes, sir.
This was in fact an overview. Today's intention was to give you only some brief understanding about this valuation process and valuation approaches. Method is a detailed thing we'll be learning in appropriate time, different valuation method. But before that, what is more important is to know some concepts which are called as the value drivers. For example, let us say you need to know what is the return. What is the concept of return? What is the concept of risk? What is the return concept of systematic risk, unsystematic risk? Most of the things you might be knowing. Is it not? What is time value of money? Because all these concepts will be helping you to apply your judgment skills. Okay, and this is an area, and this is a practicing area where a lot of judgments and lot of assumptions are involved. Right, friends? Any query, anything you would like to ask me right now?
No, sir, till here we understood. Maybe we will practice more while practically making it. We'll have more queries.
Yeah, that we have to do. Okay, ultimately, our intention is you should be practically able to compute the value of a company, practically able to compute the value of some equity shares. So with the limited classes we have, we'll try to complete that. We'll try to learn all this. Okay, friends. So thank you very much. So we'll catch up in your next session. Thanks a lot.
Thank you, sir.